As we approach the end of another tax year, financial planners have, as for every other year, a brilliant opportunity to effectively communicate with their clients and prospective clients. You'll be aware that over much of 2022, tax was very much front-page news, and given the economic and fiscal challenges facing the government, but this year, even more so. Tax reduction seems to be an unlikely prospect for some time to come. As a result, we have frozen tax thresholds and the lifetime allowance for even longer, until 2028, April 2028. The additional rate threshold reducing from £150,000 to £125,140 from the 6th of April 2023. The dividend allowance halving to £1,000 from the 6th of April this year and halving again in April 2024. The capital gains tax exemption reducing from £12,300 to £6,000 in April this year and halving again to £3,000 in April 2024. So as well as ensuring that, as for every other tax year end, clients at least give thought to maximising the rule of use it or lose it in relation to allowances, exemptions and lower tax thresholds, there could be additional incentives for some to think seriously about action this year. Particularly those who will be adversely affected by the reduction in the dividend allowance, the CGT exemption, and the lower additional rate threshold. And of greatest relevance to financial planners, the changing tax environment will be experienced by most obviously by investors and SME owners. For investors, the reduction to the CGT exemption, the dividend allowance and the additional rate threshold will mean that the value of the tax sheltering offered by registered pensions and ISAs will be even more attractive. Also, those reductions in the dividend allowance and the annual CGT exemption will mean that the investment threshold above which tax deferment and tax management given by investment bonds will be materially lower, so the threshold above which you consider them will be lower. For SME owners, the reduction of the dividend allowance and the April 2023 increase to the corporation tax for companies with profits over £50,000 will also need to be factored into the dividend, salary, pension consideration in the next tax year. For this year, as ever, business owners should give thought to how they can minimise tax and national insurance on what they want or need to extract from the company for current use. For funds not needed for current personal expenditure, then contributions to registered pensions, within the usual limits of course, remain the most tax-efficient method of extraction. Now, aside from the reduction in the capital gains tax exemption, we have capital tax stability. But advisors have a responsibility, in my opinion, to encourage those of their clients for whom it's relevant to at least consider deploying the use it or lose it CGT and IHT annual exemptions before the tax year end. Offering your clients a tax health check to screen for unused tax efficiencies could represent an excellent way to prove the value of your relationship through highly timely and relevant proactivity.